want to bring in Jason Trennert. He's the chairman and CEO of Strategas Research Partners, which is a Baird company. And Jason, I know you've been thinking about the Fed. Everybody has. Expected to hike this week, and then what? And you're of the opinion that they're going to be pretty hawkish with the commentary.
I think so. And I think certainly given the data lately, because they clearly want to slow the economy down, there's clearly, I would say, some employment pressures. You thought unemployment claims were rising. They're actually now started to fall again. And the Fed's very concerned about labor. So I think the Fed's going to tighten tomorrow and then talk pretty hawkishly about the September meeting. Now, this is the biggest pause of the year, if you will. This is the biggest stretch of time between Fed meetings.
Yeah.
And so there's probably an extra incentive to talk a little bit hawkishly, I think. But I'm not sure it might matter much for the markets, given the way they've been trading. But
you brought up something that I hadn't really thought in this context. Do you think the Fed's going to be watching all of this labor strife and the potential strikes as another issue because higher wages leads into inflation down the road?
I don't think a small percentage of the U.S. workforce right now is unionized, at least among the private sector. There's more public sector union members now than private sector union members. So, but in the 70s, 30% of the workforce was unionized, and that's how you got a wage price spiral. Here it's a little bit different. It's different now. But by the same token, they set the stage, at least from a news cycle point of view, or at least just framing, for everyone else that's out there. And if you looked at United Airlines, you look at some of the airline pilots, they've gotten very rich already, very rich. I'm not saying they don't deserve them, but 40% over 4 years is meaningful. Then you have the Teamsters, UAW, and Hollywood. And to me, they're going to be watching those negotiations very carefully, because if those get set as high as the airline pilots are, it seems to me they have more work to do.
You've been waiting for this recession that the bond market's been signaling for forever at this point, waiting for the markets to kind of fall into that slump. And at the same time, we've seen this crazy melt up.
Yeah.
How do you make sense of that?
Well, listen, I think, first of all, the economy's more resilient than we had expected. So, so you could say, we're early, but that's like a euphemism for wrong. So the economy is clearly more resilient than we thought. Also, though, I would say if you look at the stock market this year, if you look at the S&P 500, during the week of Silicon Valley, the S&P was up 0. It was up 58 basis points in early March for the year to date. As soon as Silicon Valley Bank failed, the market took off, and that was largely because the Fed stopped quantitative tightening, injected a lot of money into the system, and then you also had the Treasury that was injecting a lot of liquidity because of the budget ceiling, debt ceiling. So, listen, that's how I make some sense of it.
But, if the facts change, have you changed your opinion of what happens next to stocks?
It seems to me, though, given the valuations of the market, let's say I'm less bearish. By the same token, I don't know if I'd be putting a lot of extra money to work here, because the market's trading largely at pretty close to 20 times expectations of next year's earnings, which are at this point, still pretty optimistic. There's absolutely it seems to me, very little chance of a recession in where the market is trading today. Very little recession is actually priced into the market today, and that makes me worried. The risk-reward seems to be upside down. You're risking probably $2 or $3 for every dollar you might make in the S&P 500, and generally you want that to be the opposite. You want to make $3 for every dollar that you're risking.
What are you looking for in earnings this week?
Listen, I think it's all about the guidance, right? The earnings, I think, have come in better than expected so far. They almost always do, but it's really about the guidance. And I think you saw that with some of the tech names last week, where the numbers were good, but whether it was Netflix or Tesla, the guidance was a little squishy. And
we saw it with Ryanair this morning.
Right.
Too.
So it's always about the guidance, and it seems to me that that will tell the tale with a third of the S&P 500 reporting this week.
So what do you do right now?
My own opinion is you want to stay close to shore. You want to focus on a lot of quality. There's still an awful lot of companies. 40% of the Russell 2000 hasn't had a profit in the last year. So you want to focus, given the fact the cost of capital is rising and has risen meaningfully, and we have not seen the full impact of that increase in the cost of capital, it seems to me you want to focus on the quality companies, right? The shorter duration companies that have the ability to give money back to shareholders. Now, the thing is, that includes the Magnificent Seven, probably most among any company, right? Because they generate tons of cash. They don't necessarily have to put it back into CapEx or R&D. They could just wind up giving it to shareholders in the form of dividends or share repurchases. So you have to be very careful because that's a big portion of the market. By the same token, I think for everyone else, I think you really want to focus on companies that can reliably put up earnings and give money back to shareholders.